Hi. Let's learn about interest rates and what they mean to borrowers. Today, we will talk about different types of interest rates and how they impact borrowing and savings. An interest rate is the amount a lender charges a borrower and is a percentage of the principal, which is the amount loaned. The interest rate can also apply to the amount earned at a bank from a savings account or CD. For example, the annual percentage yield refers to the interest earned on these deposit accounts. Interest is essentially a charge to the borrower for the use of an asset, and it can be thought of as the cost of money. Interest rates apply to most lending or borrowing transactions, and they can affect individuals and businesses alike. The interest rate is the cost of debt for the borrower and the rate of return for the lender. When the borrower is considered low risk by the lender, they will usually be charged a lower interest rate. However, if the borrower is considered high risk, they will be charged a higher interest rate, resulting in a higher cost loan. If you take out a loan with a simple interest rate, you will have to pay interest based only on the original principal amount. For example, if you take out a $300,000 loan with a 4% simple interest rate, you will have to pay $12,000 in interest at the end of 1 year. After 30 years, the total interest payment would be $360,000. With compound interest, the borrower pays even more in interest because it is applied to both the principal and the accumulated interest from previous periods. The amount owed in interest at the end of 30 years on a $300,000 loan with a 4% compound interest rate would be almost $700,000. When you save money using a savings account, compound interest is favorable because the interest earned on these accounts is compounded. This is compensation to the account holder for allowing the bank to use the deposited funds. On the other hand, while interest rates represent interest income to the lender, they constitute a cost of debt to the borrower. Interest rates on consumer loans are typically quoted as the annual percentage rate, which doesn't consider compounded interest for the year. On the other hand, the annual percentage yield, APY, is the interest rate earned at a bank from a savings account or CD, and it takes compounding into account. The interest rate charged by banks is determined by factors such as the state of the economy. A country's central bank sets the interest rate, which each bank uses to determine the APR range they offer. The interest rate is changed as a tool to influence the economy, and higher interest rates make borrowing more expensive, while lower interest rates stimulate spending and investment. Despite laws that prohibit discriminatory lending practices, systemic racism prevails in the U.S. Homebuyers in predominantly black communities are offered mortgages with higher rates than homebuyers in white communities. This disparity can add almost $10,000 of interest over the life of a typical 30-year fixed-rate loan. The Federal Reserve uses interest rates as a monetary policy tool, influencing many other interest rates such as those on personal loans, business loans, and mortgages. By increasing the cost of borrowing among commercial banks, the central bank can cool off a hot economy. On the other hand, lowering interest rates makes borrowing easier, stimulating spending and investment. Here are 5 key takeaways. 1. The interest rate is the amount charged on top of the principal by a lender to a borrower for the use of assets. 2. An interest rate also applies to the amount earned at a bank or credit union from a deposit account. 3. Most mortgages use simple interest. However, some loans use compound interest, which is applied to the principal but also to the accumulated interest of previous periods. 4. A borrower that is considered low risk by the lender will have a lower interest rate. A loan that is considered high risk will have a higher interest rate. 5. The APY is the interest rate that is earned at a bank or credit union from a savings account or CD. Savings accounts and CDs use compounded interest. Hope this would help. Thanks for watching.